Let's get a check of what's happening in the world of business. Our business editor, Kate Moody's here. Hello, Kate.
Hi, Tom.
The US central bank has significantly raised interest rates. All of this part of a bid to tame soaring inflation.
Yeah, really pulling out the big guns this time after moving by first quarter and then half percentage point increments in March and May, respectively. The U.S. Federal Reserve has now raised interest rates by 0.75%. It's the first time it's moved by such a large margin since 1994. The move brings the federal funds rate to between 1.5% and 1.75%. The Fed is expected to continue raising rates throughout the year, not necessarily at the same pace, but to bring that key rate to at least 3% by the end of 2022. Higher interest rates tend to encourage consumers to save rather than spend, and that helps keep inflation in check. Consumer prices were 8.6% higher in May than a year earlier. Federal Reserve Chairman Jerome Powell said the bank is committed to bringing inflation back towards its 2% goal.
We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation.
Jerome Powell speaking just earlier there. Well, let's cross over now and speak to Christian Lawrence, Senior Market Strategist at Rabobank in New York. Thanks for being on France 24. Today's 0.75% move had been telegraphed in recent days, but it does represent a real shift from what we were hearing just a month ago.
Yeah, that's quite right. There was an article out on Monday that essentially signaled that the bank was going to raise rates 75 basis points. But prior to that article, most people were expecting another 50 basis point move. But I think this really highlights the difficult situation the Fed is in at the moment, given they are facing the worst possible scenario for a central bank: supply side driven inflation and slowing consumer. So it's going to be a very difficult road ahead for sure.
Do you think the Fed waited too long to act on interest rates?
I think it's easy to say that in hindsight. The issue is the primary driver of inflation we're seeing at the moment, as we just heard from Jerome Powell himself, it's food, it's energy, and it's housing. And certainly when we look at the food and the energy components, those are completely outside of the Fed's control. So essentially, the Fed didn't really want to raise rates to try and tackle inflation that it doesn't have the tools to tackle properly. So they wanted to wait to see how the consumer was looking. But then the Russia-Ukraine situation threw a big spanner in the works, and we saw another surge higher in food and energy prices, to the point that the Fed could no longer wait to see what happened and had to act.
Certainly a lot of factors in play here. Remind us concretely how this move on interest rates will affect American consumers.
Well, primarily, it's not going to help when it comes to this food and this energy situation, because that is something that the world is facing and is really outside of the US. It's completely out of the Fed's control. There is some hope that it will help cool the housing market, however, but really we are seeing the Fed raise rates and hiking the US into a recession, because households will still have to purchase energy. They will still have to use transportation. They will still have to purchase food. So what this means is that consumers will have less money to spend on other goods. Quite frankly, it is a bad situation to be in.
And the Fed, like many other central banks, really trying to do a balancing act here, right? With this idea of a soft landing, tightening monetary policy while still keeping the economy and labor market going. Do you think that they may have struck the right balance, at least for now?
No, is the short answer to that. I think the US consumer is about to hit a brick wall, quite frankly. We're already seeing early signs of stress within particularly low-income households. We're already seeing consumer confidence start to collapse. And just earlier today, we saw a contraction when it comes to retail sales. So I think a hard landing and a recession in the US is inevitable.
So not much the Fed can do, perhaps, and all these other factors that are going on outside of the United States that are impacting inflation there. What moves might protect households and businesses in the United States?
Well, unfortunately, when it comes to the Fed itself, it just doesn't have the tools to provide much relief from that perspective. So it really comes down to government policy and to the fiscal side of things to try and find support. But I think this is a deliberate slowdown for the consumer. The Fed has essentially had to choose between two bad scenarios. Does it risk inflation really getting out of control and we start seeing double-digit increases? Or do we go through a recession that the Fed hopes will be relatively mild? So it's a lose-lose situation. They have just gone for the least worst option, essentially.
Now, investors around the world, of course, have been closely watching this decision from Washington. How do these sorts of decisions by the Federal Reserve impact other parts of the world? We know inflation is a widespread problem. The European Central Bank also poised to raise interest rates for the first time in over a decade in the coming weeks. How does the Fed decision play into all of that?
Well, the Fed plays a huge role because it is the most important central bank in the world. So when we see the Fed raising rates aggressively, we tend to see more strength in the US dollar as well, which of course means other currencies around the world are weakening at a time where they're also importing high inflation. So a more aggressive tightening cycle from the Fed, quite frankly, that encourages other countries to engage on a more aggressive tightening cycle as well, to try and keep those interest rate differentials from widening too much. So the Fed's actions are absolutely critical for all central banks around the world.
I also want to ask your opinion about today's rather surprise meeting by the European Central Bank, not directly addressing inflation, but this announcement of new tools to address the widening difference in borrowing costs for member states. Some analysts have expressed surprise that an emergency meeting was called to address that. What's your reaction?
Well, last Thursday, there was the surprise that essentially the ECB didn't come out with what we call an anti-fragmentation plan, i.e. a plan to prevent things like Italian interest rates rising too far versus German interest rates. That plan didn't happen, so the market essentially started pushing those Italian spreads much wider relative to the German spreads. So essentially, by the ECB not getting ahead of things and providing a plan when there was calm, the market created some panic, forcing the ECB's hand to move. I think this is another good example of why central banks need to try and get ahead of these things rather than waiting for the panic and then reacting in an emergency type manner, as we saw today from the ECB.
All right, Christian Lawrence, I'm afraid that's all we have time for. Thank you so much for your time and insight on France 24 this evening. And Tom, that's all for now. I'll be back in about half an hour's time with the closing word on Wall Street, the reaction to all that news from the Federal Reserve.
Yeah, I think there'll be quite a lot of reaction. It's been a busy day, hasn't it? Thank you very much indeed. Our business editor, Kate Moody.